Thank you for staying tuned. Well, the last 24 hours has seen slight recovery across global markets that were lately affected by the coronavirus panic. This is due to the responses by policymakers in advanced markets as speculative investors close in positions ahead of G7 call aimed to offer trading cues to traders. Here in Nigeria, the reverse seemed to be the case as investors continue to sell down their shares and yields at the fixed income space take up on fears of the index case in Lagos. While the head of portfolio management at Commercial Partners Asset Management, Victor Aluyi, joins my colleague Temple Ashaju to weigh into this conversation. Temple.
Sure. True, Chimeze, thanks a great deal because this is a very, very important conversation at this point in time. A lot of investors, retail and institutional investors are betting, are actually making losses at this point in time. So it's actually important to listen to Victor Aluyi, who joins us from Commercial Partners, to wade into this discussion and talk to us about what has actually transpired in the market in the last 24 hours. Because we know that last week alone, global markets actually lost about $6 trillion. Yes. What has changed since the slight reversal that we saw yesterday alone?
Okay, I think what we've had over the last week plus is what you might want to describe as a black swan event, something that you didn't quite anticipate. So the outbreak of the coronavirus, which was largely endemic to China when it broke out, even at that, because of how strong the Chinese economy is and how much it contributes to the global economy, there were strong concerns. But immediately that crisis became pandemic and started to spread to other countries and then started to assume a global proportion. It really was all bets were off, and it became significantly risk-off in the global markets. For context, like you pointed out, global risk asset lost over $6 trillion. Gold, which is a safe haven asset hit its highest point in about 7 years. We also saw the U.S. Treasury, the 10-year Treasury, hitting its lowest points in a very, very long time. So this basically indicated to you that in the market, everyone was trying to run away from risk, essentially. However, over the last 24 to 48 hours, there are strong indications of some sort of ongoing concerted efforts, particularly on the part of global central banks, the US Fed, the ECB, the Bank of England, even the Bank of Australia. Bank of Japan as well. There are chatter about some sort of accommodative policy, if you will. Suffice it to say that this crisis isn't necessarily one that monetary policy would solve, because you need to bear in mind that what we're essentially experiencing is it's a supply side shock, right? It has nothing to do with demand right now. It's a supply side shock. So typically monetary policy is meant to sort of boost, demand. However, what this also means is that, the monetary authorities globally are essentially standing pat, and they would be ready to do whatever it takes to ensure that they support, the global economy. So it's a very positive, indication, if you will, on the part of global central banks standing ready to do whatever it takes to provide some support. And the Federal Reserve Chairman issued a statement on Friday, which was quite rare. The Federal Reserve typically wouldn't issue those kind of statements, but apparently the pandemic nature of the crisis required that kind of statement was issued, and it served to sort of calm markets a bit. And I would also say that I believe that a lot of the negative news, a lot of the negative expectations really have been, priced into a large extent. So right now the market is looking for any type of positive news that it can hang on to. So anything that seems remotely positive, the market is essentially going to just hang on to it.
But really, what sort of move do you see these bankers and ministers of finance, making? These are the key policymakers. Talk about the monetary policy side and, of course, the fiscal policy side of things. We know that everyone is now looking forward to the G7 call, the G7 finance ministers. What exactly would you be anticipating them, to churn out in terms of policy now in the next few sessions?
I don't expect anything significant in terms of policy. What I would expect would be essentially messages of solidarity, messages that would essentially serve to calm markets. Because if you look at where global monetary policy is, there isn't much legroom in terms of easing from where we're at right now.
But the Fed is proposing a 0.25% easing or thereabout.
Yeah, so that will basically take us to just slightly below 1% for the Fed.
And
so
it won't calm enough nerves.
It would serve to calm, because the truth of the matter is that whatever it is that you get now would largely be a palliative measure. In the absence of proper traction and progress, in confronting that crisis, in the absence of proper traction on the biological front, if you will, we would need to see a semblance of a containment, if you will. So yes, the virus might continue to spread, but if it even spreads at a reducing rate, or there's been chatter about a vaccine that's down the road. If we get
made news that investors will really want
exactly, if we get good traction on that front, it would serve to really significantly ease nerves. But whatever the monetary authorities do would basically just calm and assuage nerves. It would just basically tell us that the central banks are going to be there. They're going to be available to provide whatever support that is needed. Should the crisis, continue to go on, So I think, in terms of a coordinated policy, it's really tough for me to see what would happen, particularly from a fiscal standpoint, really. But from a monetary standpoint, I think we're going to see some coordinated easing globally, essentially to just prop up the global financial system, really.
But is that likely to be the case for us locally? Because again, if you look at the global trend, it's totally different from what obtains internally here. Why
Absolutely.
haven't we seen a positive response? Our President Muhammadu Buhari, actually made a comment yesterday, and one would literally expect that to actually bring about a turnaround in the market.
Yeah, so we deal with our own idiosyncratic issues here in Nigeria. If you look at the global market, what had happened was that, particularly in the US, valuations had run ahead of fundamentals. And when you have a major shock like this, it tends to pull those valuations down back to where fundamentals are, or in some cases below those fundamentals, and the market essentially re-rates at that point. What we've had in Nigeria is a case where the economy has essentially struggled to grow. The last GDP number offers some glimmer of hope. However, if you look at over the last couple of years, the economy really has struggled to grow. So from a broad macro perspective, there are challenges. If you look at the banking sector, which, the index is really bank heavy, and, you've had over the last 18 months a barrage of regulatory pronouncements that essentially would just kind of make business a bit more challenging for the banks. So if you put all of these factors together, there doesn't seem to be much to be cheerful about, with the market. So our own homegrown issues continue to bedevil us. Suffice it to say that if you look at what's happened with crude oil as well, what had happened with crude oil typically had an impact on our market, although that is beginning to sort of recover now based on some of the positive news we're beginning to get. The OPEC ministers are going to meet, I think, Friday to decide whether they're going to increase the sort of curbs that they want to implement to about 1 million, and all of that. So I think for Nigeria, we have, homegrown issues that continue to affect us until we begin to see the economy really pick up steam, grow significantly. It'll be tough, for the market to really break out of this cycle.
So what you're saying in essence is this, that the whole regulatory headwinds around, I think on Friday there was a debit in CRR that impacted the interbank call market. There are challenges around meeting our 10 trillion naira budget now with all of the decline that we're seeing in this crude oil and a whole lot of things. But basically, by the end of the month, 22nd, 23rd or thereabout of this month, we should see the CBN and MPC, meeting for the second session this year. What sort of decision would you want them to, come on board with?
Well, I think the most formidable challenge that the Apex Bank confronts right now is really price stability. And when I talk about price stability, I'm talking about exchange rate right now. That's the most formidable challenge. If you look at what's happened to reserves over the last couple of months, further exacerbated over the last week or so with the whole coronavirus outbreak, particularly with what has happened to oil prices. I think that's a major challenge that the Apex Bank confronts. So I would believe that the Monetary Policy Committee would provide some sort of guidance or provide some sort of, if you will, context in terms of their plans, in terms of what they are exactly going to do with regards to exchange rates. With regards to regulation, there might need to be a bit more clarity, particularly with regards to the sort of debits that we're seeing with CRR. Are these really induced by the regulatory threshold, or is it just a case where the CBN is essentially just trying to manage liquidity in the name of those CRR debits? So those are things that will require some clarity about, and I would believe that these are issues that the committee would address. In terms of the benchmark rates, I'm not really sure that anything significant would happen there. Because at least over the last couple of years, I would say that what we see in the treasury bills market has essentially served as, if you will, a benchmark to what happens, in terms of pricing, in that market. So, yeah, some clarity really with regards to these debits, liquidity management, and obviously on the FX front as well.
Okay, so Victor, we all know that the markets are better integrated now. Now you can sit down in Lagos, you can sit down in Zamfara and find a way to buy Apple shares in the US.
Sure.
You can sit down anywhere upland or even in Lagos and buy Dangote or buy MTN or buy any share of interest to you.
Yes.
At this point in time that we're beginning to see so much of negative reactions to the markets, what sort of which of the markets should we focus in on? Should we be targeting foreign stocks, or we should be looking at local equities?
Well, once you have a significant risk-off environment, in that situation, typically cash is king. Truth of the matter is that we want to believe that the worst of the crisis, the coronavirus outbreak, is kind of like behind us. However, there are still moving parts that continue to evolve, so that risk-off environment is not completely off. So once you have that risk-off environment, it is important that you pretty much try to stay in cash so that you're able to reassess the situation and know what you want to take advantage of. So for our local markets, we believe strongly that the banks, particularly the top-tier banks, still hold some good value, because we believe that they are well poised to weather whatever regulatory headwinds there are, within the market. We would need to see some traction on, broad macro growth for us to really be able to look at the consumer goods guys, because they're obviously directly related to consumer spending and obviously growth in the economy. So for the industrials, again, would need to see significant increase in our capital expenditure, which obviously directly trickles down to these guys. So I think key issue really is, from a broad macro perspective, things really need to improve. We need to see some good traction on that front for that to cascade into the equities market. Suffice it to also say that regardless of this background that I've given, I think that there will always be opportunities every now and then within the market to take advantage.
Where's the opportunity at this point in time? If you look at the debt market side of things, it's not looking attractive enough. The OMO side was down. We saw advancements in the yield curve yesterday. NCB, there were just 2 T-bills reported, at the secondary markets yesterday. And of course, look at the bond side of things. Everyone is, shedding their loads, on all of those papers. I mean, so where's the opportunity? There's no commercial paper at this point. Equities is down.
Yeah, well, the truth of the matter is that even with the challenge, if you will, that you're having now within the fixed income market, which I would largely describe as short-term noise, there are still opportunities there. You need to constantly monitor that space to get a sense of how the regulators are moving, how things are shaping up in that space. But I still think that the opportunities there are still quite decent. On the long end of the curve, you can still get north of 12%, so which is quite decent, at this moment. The challenges are here and now, but I think in another couple of months, we'll just look back on it and it will just be a blip, really, for the year. However, how you navigate this period is extremely important to be sure that value doesn't get wiped out, or you create value, either way. So it's a very dicey situation, but we have to create a fine balancing act, between that risk and reward, really, as it is right now.
So what does this tell you about Q1 numbers, when companies will begin to release their earnings for the first quarter of the year?
Well, it won't be significantly different from what we've seen for a number of the guys that have released their FY19 numbers. It will also continue to reflect, again, the broad macro story, the broad macro situation that we have, in the country. It really, for the banks, again, the tier 1 guys still have that balance sheet to be able to weather the storm. We're not going to see the sort of breakneck growth that we saw a couple of years ago. However, we would see them basically consolidate on growth. And for them, we're beginning to see a shift away from interest income. We're beginning to see significant growth in that non-interest income area, particularly from e-channels and co. So obviously, these guys have the balance sheet to continue to play in that area and to scale that up. So we believe that they're well positioned to weather the storm.
Now we've heard of forecasts around some kind of economic recession. We've seen that the fall last week alone took us back to the levels we last saw markets as far back as year 2008. What will the possible economic recession mean for an average individual and an average Nigerian, more specifically?
I mean, you don't need to look too far. Just a couple of years ago, we slid into a recession. But I think I must point out here that I don't think that those risks are very formidable for a recession. Yes, what's happening in the market right now is quite dire. The market is down. But if you look at the economy as a whole, like I pointed out, full-year GDP numbers were released recently, and that was the highest that we had seen since we slid into a recession. So I want to believe that we'll continue to consolidate on that growth path. The agricultural sector continues to grow. Sectors like ICT continue to grow and continue to contribute quite significantly to GDP growth. And I think that would continue in the near to medium term. If you look at the impact of the coronavirus on our economy, I don't think it would be as strong as what you would probably have on some other economies. Yes, we are interwoven and intertwined. It would have its impact, but it would not be as significant. So I would think that the sort of growth that we have seen, particularly for full year 2019, will continue to consolidate on that. And if we do, I don't think we're going to see a recession. Yes, the market is could remain, subdued, for some time. But nevertheless, there are going to be opportunities within that market to still, make good on your positions.
We have seen IMF and some other multilateral institutions revising the projections, the growth projections for the globe, for sub-Saharan Africa, for countries across the globe, especially those of us that have been hit by this epidemic. Do you think this will come through eventually, in spite of the fact that we have maintained a bit of a momentum from the quarterly growth that we've seen in the past?
It should have some impact because the proportions of this crisis is quite enormous, basically close to what we had in the 2008 financial crisis. So it certainly would have its impact. The magnitude is a different thing now. I don't think that magnitude should be really, really significant for Nigeria, really. I think we should be able to weather that storm and forge ahead to sort of consolidate on the kind of growth that we've seen coming through from 2019. Yes, the IMF has come to revise those growth projections lower. And if you look at for Nigeria, I think they just probably cut it by about 0.1% thereabouts. So it shouldn't be really heavy from our own standpoint, really, for Nigeria, really. And as long as the fiscal authorities and the monetary authorities remain really proactive, it would really help to ward off whatever potential crisis there could be.
So the suggestion that we've seen in the dailies today is that this could actually hit the 10 trillion naira budget that Nigeria has, because again, crude oil price has declined, 51 to a little close to $52 per barrel.
Yes.
And of course, that's far from the benchmark crude oil price that we set in the budget. What are your thoughts on this? Do you see that really happening eventually? Well,
I mean, we've been challenged revenue-wise for quite a while now. And what's happening now would essentially further exacerbate that. But it is important to keep in mind that what is happening now, except, of course, we have a prolonged crisis, which I really don't see from where I am, because there's a concerted global effort that's going on right now. So I don't think that this crisis will
and eventually this will bring the federal government back to the capital market around the bonds and see how they can probably raise the bar.
Absolutely. That's going to be something that the federal government will certainly significantly consider.
So also consider the sell down that we've seen across the markets. Then those that are holding cash now will have opportunities to then push these funds back.
It will be a good opportunity to do that.
Victor, thanks a great deal for joining us on the program. Thanks for sharing your insights.
Thank you for having
your thoughts here.
Thanks
back to you now, Chimezie.
Thank you, Temple. Well, we'll take a quick break, and when we come back, we'll do an opening call to the markets as well as London. Stay with us.